Reverse mortgages are one of the most misunderstood home loans in America. Let's clear up the confusion and explain how they really work. Let's talk about something many people whisper about. They are called reverse mortgages. You might have heard scary stories from a neighbor. Maybe you saw a confusing ad on late-night TV. The topic can feel complicated and even a little frightening. Because of this, many people simply tune out. They decide it's not for them without ever learning the facts. But ignoring a financial tool because of rumors is not a good plan. It is much better to understand your options. Knowledge gives you power. It helps you make smart choices for your financial future. This essay will clear up the confusion. We are going to explain reverse mortgages in plain, simple English. There will be no jargon. There will be no sales pressure. Our only goal is to give you the information you need. We will talk about what these loans are, who they can help, and who should probably avoid them. Think of this as a calm, friendly conversation about a financial product. By the end, you will have a much clearer picture. Section 2. What exactly is a reverse mortgage? So, what is a reverse mortgage? Let's make it simple. A reverse mortgage is a special type of loan. It is designed for homeowners who are age 62 or older. It allows you to convert a portion of your home's equity into cash. Equity is the difference between what your home is worth and what you owe on it. If your home is worth $400,000 and you have paid off your mortgage, you have $400,000 in equity. This loan lets you borrow against that value. It's called a reverse mortgage because the payment stream is reversed. Instead of you paying the bank each month, the bank can pay you. You can choose to get a single lump sum payment. This might be useful if you have a large one-time expense, like a major home repair. You could also choose to receive steady monthly payments. This is like getting an extra paycheck to supplement your retirement income. Another popular option is a line of credit. You can draw from this line of credit as you need the money. You only pay interest on the amount you actually use. This flexibility is one of the main attractions for many people who consider this type of loan. A very important point to understand is that you keep ownership of your home. The bank does not take your house. You continue to hold the title, just as you do with a traditional mortgage. The lender simply places a lien on the property. You are still the owner. You can live in your home for as long as you want. The loan simply has to be repaid at a later date, which we will discuss in detail a little later on. Section 3. Who is a reverse mortgage for? Who is it not for? Reverse mortgages are not a one-size-fits-all solution. They are designed for a very specific group of people in a particular situation. They can be a wonderful tool for the right person. They can be a poor choice for the wrong one. A reverse mortgage can be a good fit for older homeowners who are house rich but cash poor. This means you have a lot of wealth tied up in your home and not a lot of liquid cash for daily living expenses. People may use them to supplement Social Security, a pension, or retirement savings without having to sell their beloved home. They are also for people who plan to age in place. That means living in your current home for the rest of your life. If you love your neighborhood, if your friends are nearby, and if the thought of moving is stressful, a reverse mortgage might help you stay. It can fund home modifications, adding a ramp, adding a walk-in shower, and help pay for in-home care services later in life. The primary purpose is to improve your quality of life in retirement while staying put. However, a reverse mortgage is definitely not for everyone. If you plan to sell your home in the next few years, this is likely a bad idea. Reverse mortgages have significant upfront costs, origination fees and insurance premiums, rolled into the loan balance. Selling shortly after taking the loan can make it a very expensive short-term loan. These loans are structured for long-term benefits. They're also not ideal if your main goal is to leave your home to your heirs debt-free. Because the loan uses your home's equity and the balance grows over time, it will reduce the inheritance you pass on. If leaving maximum value to your heirs is your top priority, look at other options. A reverse mortgage prioritizes the homeowner's financial security during their lifetime over the size of the estate they leave behind. The question of repayment is where much of the confusion about reverse mortgages comes from. Unlike a traditional mortgage, you are not required to make monthly payments on the loan. This can be a huge relief for retirees on a fixed income. The loan balance, however, still grows. Each month, interest is added, along with closing costs and insurance premiums. So, when does the loan have to be paid back? The loan becomes due and payable when the last surviving borrower sells the home, when they move out for more than 12 consecutive months, or when they pass away. Essentially, it is due when the home is no longer your primary residence. When one of these events occurs, the loan needs to be settled. The most common way this happens is through the sale of the home. The proceeds from the sale are used to pay off the reverse mortgage in full. Now, let's talk about your heirs. This is a very important topic. Your heirs are not personally responsible for the debt. The debt is tied to the house, not to them. When you pass away, your heirs have several choices: sell the home, refinance and keep it, or walk away. The most common choice is to sell the home. They use the money from the sale to pay off the loan. Any money left over belongs to them. For example, if the loan balance is $200,000 and the home sells for $350,000, your heirs receive $150,000. What if the loan balance is more than the home is worth? This is where non-recourse protection comes in. Your heirs will never owe more than the home's appraised value. If it's worth $300,000 but the balance is $350,000, the lender must accept the home's value. FHA insurance covers the difference. Your heirs can hand over the keys and walk away, or keep the home by paying 95% of its appraised value. Myths about reverse mortgages are everywhere. Let's tackle the biggest ones with clear, simple facts. The number one myth is that the bank takes ownership of your home. This is completely false. You, the homeowner, retain the title and ownership of your property throughout the life of the loan. The lender only has a lien against the property. Just like with a traditional forward mortgage, you are in control. You can sell your house at any time you choose. If you do, the loan is paid off from the proceeds. You keep the rest. Another common myth is that you can be easily kicked out of your home. This is also untrue. You have the right to live in your home for as long as you like, provided you meet the loan obligations. You cannot be forced to leave just because the balance exceeds the home's value. The only way you can face foreclosure is if you fail to meet your responsibilities as the borrower, paying property taxes, maintaining insurance, and keeping the property in good condition. Many people worry that their children will be stuck with a huge debt. This is a powerful and scary myth, but it is not true. A reverse mortgage is a non-recourse loan. The debt can never be passed on to your heirs. The house is the only asset used to repay the loan. Your children will never receive a bill for any shortfall. Their own assets and credit are not affected. They inherit any remaining equity. If there is no equity left, they can walk away. Finally, there is a myth that you can't get a reverse mortgage if you still have an existing mortgage. This is also false. One common use of a reverse mortgage is to pay off an existing mortgage first, which can immediately free you from monthly payments with any remaining funds available as cash, monthly payments, or a line of credit. Getting a reverse mortgage is a serious commitment. It comes with important responsibilities that you must uphold. Failing to meet these duties can lead to the loan becoming due, which could result in foreclosure. First and foremost, you must continue to live in the home as your primary residence. A reverse mortgage is not for a vacation home or a rental property. If you move into a nursing home for more than 12 consecutive months, the loan terms will be triggered. You are also responsible for all the costs of home ownership, paying your property taxes on time, every time, and maintaining adequate homeowners insurance. If you fail to pay, the lender may pay them on your behalf and add the amount to your loan balance. Continued non-payment is a default and can lead to foreclosure. Finally, you must maintain the home in good condition. Basic upkeep and repairs to prevent serious disrepair. Think of it this way. Do all the things a responsible homeowner would normally do. Like any financial product, there are clear pros and cons. Pros: improved cash flow in retirement without selling your home. It can provide financial stability and peace of mind, and help with unexpected medical bills or large expenses. Cons: the upfront costs can be high. The loan balance grows over time, reducing the equity you will leave to your heirs. And if you are not diligent about taxes and insurance, you risk losing your home. It is a trade-off you must weigh carefully. So, when does a reverse mortgage make sense? It can be a powerful tool for a homeowner who has a lot of equity but is struggling with monthly expenses. It makes sense for someone committed to living in their home for many years and wanting more financial security in retirement. If you have done the math and realize you need more income to live comfortably and your home is your biggest asset, it is an option worth exploring. It is for the person who prioritizes quality of life in later years over leaving a large, debt-free property to heirs. Conversely, if you are not sure you want to stay long-term, do not get a reverse mortgage. High upfront costs make it a poor choice for a short-term need. If you cannot comfortably afford ongoing property taxes and homeowners insurance, this loan will add stress, not relieve it. If your primary goal is to pass your home's full value to your children, look for other solutions. A reverse mortgage is a tool for the living, not for estate planning. The first step is mandatory and incredibly helpful. Before you can even apply for a HECM, you must complete a session with an independent, HUD-approved counselor. This person does not work for any lender. Their job is to make sure you understand the loan, its costs, its responsibilities, and discuss alternatives. Talk with your family, speak with a trusted financial advisor. Take that counseling session seriously.